Okay, let's talk about one of the biggest, most frustrating traps for any index trader. You see a huge price move overnight, you jump in, and then you watch it completely evaporate the second the real market opens. So, we're going to break down exactly why that happens and, more importantly, how you can stop getting faked out by it. Come on, I bet we've all been there, right? You wake up, you see the futures market just screaming higher or tanking, and you think, this is it, this is the trend for the day. So you chase it, and then poof, nothing. The whole move just gets erased. It's not just frustrating, it can be a really expensive lesson to learn. And this quote right here, it just nails the whole problem, doesn't it? The move reversed the moment real money showed up. That phrase, real money, is everything. It points to this massive difference between what happens overnight and what happens during the main session. And, understanding this isn't just some academic thing. It's a real edge. So what is really going on here? Well, the reason those overnight moves are so deceptive is because you're actually looking at two completely different markets. I mean, yeah, they're trading the same product, but they have different players, different amounts of money flowing through them, and this is the key, totally different levels of conviction behind any price move. Think of it like this. On one hand, you've got the overnight futures market. It's kind of like a quiet side street at 3 a.m. It's a thin market, which means there are not a lot of buyers and sellers around, so even a pretty small order can push the price around in a big way. But then you have the US cash session. That's not a side street, it's a 10-lane superhighway during rush hour. It is incredibly deep. It's packed with big money institutional traffic, and it takes an absolutely massive amount of capital to really make a dent. And this is a great way to picture that thin market. What this really means is that you can't totally trust the prices you're seeing. They can be pretty flimsy because there just isn't a deep bench of orders ready to absorb any real buying or selling. A single news headline can come out and cause this wild-looking spike that doesn't really mean much. And here's the complete opposite. The cash session is deep, spreads are super tight, and there's just a sea of liquidity. This is the arena where the giant pension funds, the mutual funds, all the major institutions are playing. So when price moves here, it has weight. It has conviction behind it, because it represents what the biggest pool of capital in the world actually believes. Now, to put some real numbers on this, think about this for a second. During those quiet overnight hours, it might only take something like $5 to $10 million to move a major index future, like the S&P 500, up or down by 10 points. Now, that sounds like a lot of money to us, but in the world of global finance, it's barely a drop in the bucket. Okay, now compare that to the cash session. To get that exact same 10-point move during the day, it can take over $50 million. That's 5, maybe even 10 times more capital. And that's the whole game right there. A 10-point move looks identical on your chart, but the money and the belief behind it are from two different universes. So a really cool way to frame the entire 24-hour trading day is to think of it like a 3-part relay race. Each major global session, Asia, London, and the US, hands off the baton to the next. And each leg of this race has its own unique personality. The price action we see is just the story of that handoff. All right, so the race kicks off with the Asia session. This is the first runner out of the blocks, but they're running on the absolute thinnest volume of the day, maybe just 5 to 15% of what we'll see later on. Asia's main job a lot of the time is to just set the high and low guardrails for the overnight period, usually just reacting to whatever news came out after the US market closed. Then London gets the baton, and this is where the first wave of serious institutional money logs on for the day. And what's one of the first things they do? A lot of the time, they test the boundaries that Asia just set up. There's a classic pattern called the London reversal, and it's basically this new wave of capital looking at those overnight highs or lows and saying, nope, we don't agree with that, and then pushing the price right back. And that brings us to the anchor leg, the US cash session. This is where the full, overwhelming weight of global capital all comes together. It takes the clues from Asia, it looks at what London did, and then it delivers the final verdict. Because this is the deepest pool of money, the price action here is the most honest, and it carries the most weight. This is where the day's real story gets written. Okay, so this whole relay race story, it sounds good, but do the actual numbers back it up? Oh yeah, absolutely. This tendency for overnight moves, or gaps, to just reverse and disappear isn't just a fun little anecdote. It's a cold, hard statistical probability. And this table right here, this is the proof. It breaks down those overnight gaps by how big they are, and then shows how often they get filled, which just means the price travels all the way back to where it closed the day before. and the pattern is impossible to ignore. The smaller the gap, the more likely it is to get completely erased. Let's just pull out the most powerful number on that chart. For small gaps, we're talking less than 0.25%, they get completely filled, wiped out during that same trading day about 80% of the time. Just let that sink in. If you're chasing one of those small overnight moves, you're betting against an 80% probability that you're on the wrong side of the trade. This brings us to another really useful way to think about this: reaction versus digestion. That crazy overnight move? That's the market's initial knee-jerk reaction to some headline. It's mostly driven by algorithms and fast money traders. The cash session, on the other hand, that's the digestion. That's where the big institutions with real research departments actually analyze the news and decide what it's truly worth. And this chart shows that pattern playing out perfectly. You see a headline drop, it causes a panic spike on that thin, overnight liquidity. That's the reaction. Then, as London and finally the US cash session come online, the real money starts to test that move, they begin the digestion process, and more often than not, they bring the price right back to where it started, filling the gap. Okay, this is all great information, but how do we actually use it? How do we turn all this insight into a simple, practical framework that helps us stop getting fooled by the noise and start trading with the big money? It's actually pretty simple. Here are 4 steps. First, measure the gap. Is it one of those small ones that statistically has a high chance of filling? Second, check the volume. Did the move happen on basically no participation, or was there some real interest? Third, and this is the most important one, wait. Just wait for the first 30 minutes of the cash session to see what the institutions really think. And finally, number 4, start treating those overnight highs and lows not as places to jump in, but as reference points you might want to trade against. And that all leads us to the single most important idea to take away from this. If you remember literally nothing else, remember this mental model. The overnight futures move, it's just a hypothesis. It's a theory about what the day's news might mean. But the cash session? That's the verdict. And as a trader, you always want to wait for the verdict.